Let's imagine you're scrolling through your feed late at night, and you come across a post from an old friend, someone you went to college with in Chicago. They're posing next to a shiny new SUV, captioning it something like, "Finally upgraded, life's too short." It looks great, but you can't help wondering, how are they affording that on a salary not much different from yours? It's a quiet thought, one that lingers because deep down, you know the numbers don't always add up. And that's where today's conversation starts. Most people misunderstand what risk really means in their finances, and that simple misstep quietly erodes their wealth over time. Take Alex, a 28-year-old software developer living in a mid-sized city like Denver. He's not extravagant, but he's building what feels like a normal life. After taxes, his take-home pay is about $4,500 a month. Solid for someone early in their career, especially with a degree from a state university. Rent for his one-bedroom apartment runs $1,800, which is typical in areas where jobs are plentiful, but housing hasn't caught up. Then there's the car payment, $450 monthly on a mid-range sedan he bought 2 years ago, financed at 5% interest over 5 years. Add in $200 for student loans from undergrad, another $150 minimum on credit cards for things like weekends out or that new phone, and groceries, utilities, and the occasional streaming subscription push his fixed costs to around $3,300. That leaves about $1,200 for everything else, savings, emergencies, or just breathing room. But lately, Alex has been eyeing a nicer car, maybe something with better features, because his current one feels a bit dated next to what his coworkers drive. It's not a wild splurge, it's just keeping up. Here's where the hidden flaw creeps in. Alex, like a lot of us, sees risk in the wrong places. He views the stock market or even a simple index fund as gambling, too volatile, too unpredictable. Memories of headlines about market crashes make him hesitate. Instead, he treats debt as the safer path, predictable payments, immediate access to what he wants. But that's the system flaw at play. Consumer debt isn't neutral. It's a leveraged bet against your future income, disguised as stability. Banks and lenders design it that way. Easy approvals, low initial rates, but it shifts the risk onto you. If a layoff hits or medical bills pile up, those safe payments become a trap. Let's break it down with some straightforward math, using dollars since that's the currency most of us deal with day to day. Suppose Alex finances that new car for $35,000 at 6% interest over 5 years. His monthly payment jumps to $675. Over the loan term, he pays about $5,500 in interest alone, money that goes straight to the lender. Now, imagine instead he sticks with his current car and invests that extra $225 difference each month into a low-cost S&P 500 index fund, assuming a conservative average annual return of 7% after inflation, based on historical data from the past few decades. After 5 years, that could grow to around $16,000. But stretch it out. If he keeps investing that amount for 20 years, compounding kicks in, and it might reach over $100,000. That's not a guarantee, markets fluctuate, but it's the real cost of misunderstanding risk. The debt feels safe because it's certain loss in small bites, while investing feels risky because gains aren't immediate. Psychologically, this makes sense in a subtle way. We're wired for loss aversion. Studies from behavioral economists like Daniel Kahneman show we feel the pain of losing twice as much as the pleasure of gaining. A market dip of 10% stings more than the slow drain of interest payments, even if the math says otherwise. Add in social pressures. In the US and Europe, where consumer culture emphasizes looking successful now, think Instagram feeds full of vacations and gadgets, it's easy to prioritize the tangible over the abstract. Alex scrolls through posts of friends in Berlin or New York living it up, and it nudges him towards choices that feel rewarding today, without fully weighing the opportunity cost. It's not irrational, it's human, but it's also why so many stay in a cycle of earning well but building little. If Alex ignores this long enough, the impact compounds quietly. By age 40, he might still be paying off upgraded versions of the same debts, maybe a bigger house mortgage at $2,500 monthly, or refinanced student loans dragging on. His net worth hovers around zero, or worse, negative, because every dollar servicing debt is one not working for him. Retirement savings? Minimal. Maybe $50,000 if he's diligent with a 401k match, but far short of the $1 million plus needed for a modest lifestyle in later years, assuming 4% withdrawal rates. It's not dramatic ruin, it's gradual erosion. In Europe, where social safety nets are stronger, it might mean relying more on pensions that don't keep pace with inflation, or in the US, facing higher healthcare costs without a buffer. The system rewards those who borrow for assets that appreciate, like education or homes, but punishes consumer borrowing that depreciates. Cars lose 20% value the moment you drive them off the lot. Now, let's shift how we look at this. People who navigate finances intelligently don't avoid risk, they redefine it. They see debt as the real gamble, especially for non-essentials, because it bets your future earnings will always be there. Instead, they treat investing as a calculated probability, diversifying into broad markets, where over time, the odds tilt in your favor due to economic growth. Take someone like Sarah, a marketing coordinator in London, earning similarly after taxes, about £3,000 monthly, or roughly $3,800 equivalent. She drives an older, paid-off car and invests £200 monthly into a tax-advantaged ISA tracking global indices. She still enjoys life, coffee with friends, a weekend trip, but she questions each big purchase. Is this enhancing my freedom or locking me in? It's not about denial, it's about clarity. These folks use tools like emergency funds, 3 to 6 months expenses in a high-yield savings account, to buffer actual risks like job loss. They read the fine print on loans, calculate total costs, and prioritize compounding over consumption. Over decades, this mindset turns average earners into comfortable retirees, not through genius, but through consistent, unemotional choices. In the end, understanding risk isn't about overhauling your life overnight. It's about seeing the trade-offs more clearly. When you recognize that safe debt often carries hidden dangers, while managed investing builds quiet resilience, decisions start to align better with reality. You end up not just surviving, but positioning yourself for more options down the line. If this perspective resonates, consider subscribing for more breakdowns like this. Thanks for watching.